There you go, Shippo, very good. Okay.
Yeah,
Put
thank
these
you.
on the for me.
Oh, yeah.
So that's there you go. Sorry.
Okay, well, it's great to be with you all tonight. I've got my daughter Sadie in tow with me, and she's excited to get to have a little college experience. She says she's not going to go to college because she wants to stay at home with mom and dad, but maybe we can convince her otherwise. So I'm going to talk a little bit tonight about the effects of federal tax policy, or my alternative title for this is Taxes Matter, but probably not for the reasons that you might think or that you might have heard from politicians. First, I'm going to start off with a little background about me and then some about Tax Foundation in case you're not familiar with our organization. Then we're going to go into some like super basic level stuff about national accounting and a model of the economy. Then we'll get into how taxes affect the economy and go through some examples of that. And I'm going to save some time at the end in case you guys have questions. So first, you've already heard my intro, but the way that I got into this type of work, I'm a native Kansan, and if you are familiar at all with Kansas politics, in the early 2010s, there was a great tax experiment in the state of Kansas, experimenting with zeroing out a tax rate on pass-through business income, which led to people just reorganizing essentially as pass-throughs to take advantage of that tax rate. And tax policy was like all in the news. And it got me super interested in like, this is pretty cool. And I went to a conference and I saw this map up on the screen like this. And it was a map showing a comparison of different tax rates across states. And the source was Tax Foundation. I went to their website, saw that they had an internship program, applied and got accepted. Absolutely loved the experience and knew like, this is what I want to do. And fortunately, it worked that they had an opening on their team and I got the job back in 2017, and I've been there ever since and loved it. And we are also hiring for summer interns right now. So if anything I say seems interesting to you and you want to know more about an internship at Tax Foundation, hit me up and can get you hooked up with an application. And now a little bit about Tax Foundation. We are a 501c3 nonprofit. So that means that we are essentially an educational organization. We cannot lobby, we don't advocate for specific bills or specific lawmakers or a specific party. Instead, our goal is to educate lawmakers, educate journalists, and educate the public about the trade-offs of taxes. And we do that from 4 principles of sound tax policy that you see here. First, we believe taxes should be simple. That means simple for taxpayers to navigate, as well as simple for the government to enforce and administer. That's a tall task in and of itself. On top of that, we think taxes should be neutral. So that means they shouldn't encourage or discourage particular businesses, technologies, groups of people above others, but they should be a level playing field. They shouldn't tilt decisions one way or the other. We also think they should be transparent. So that means it's easy for and clear for people to see what they owe when they owe. Taxes aren't hidden in complex structures. That's also a tall task. And then finally, stability. And this one is also from the taxpayer's perspective as well as the government perspective. So taxpayers should have a consistent and predictable tax code. It shouldn't be changing from year to year. We shouldn't see tax holidays or retroactive tax changes. It should be easy to plan your decision-making based on what the tax system is. And similarly, it should provide a stable source of revenue for the government. So you don't want your tax base to be something that's changing significantly year to year, because that has implications for government planning its budget. Something else that we do at Tax Foundation at the federal level is that we have a macroeconomic model that allows us to simulate the effects of a tax policy change on like macroeconomic aggregates, so output, income, wages, hours worked. We can also simulate how a tax change affects government revenues and the distribution of income. So does it create a tax cut for the top 1%, for the bottom quintile, that sort of thing? It allows us to do distributional analysis as well. And with that, I'm going to do some background on national accounting and a model of the economy that will kind of help you understand the inner workings of the model we have at Tax Foundation and how it works. So hopefully you guys are mostly familiar with this. GDP, gross domestic product, that's the total market value of goods and services produced in a country in a given year. That's composed of personal consumption, gross investment, that's like business purchases of fixed assets, things that are gonna last more than 1 year, so machinery, equipment, a factory, that sort of thing. Government consumption expenditures, so you can think of that as just like government spending, as well as net exports. This one can trip people up sometimes because it adds exports and subtracts imports. It's very common to hear like journalists say imports subtract from GDP, but essentially what's happening here is not that. Implicit in personal consumption and investment and government spending is spending on things that were produced in the domestic economy and spending on things that were produced elsewhere. So you're plussing one over here and you're minusing one over here, and it falls out. Alternatively, if we just measure GDP by counting up what people spend on domestically produced things, you wouldn't have to subtract out imports. So sometimes people get confused about what's going on there, and it's important to not get confused about that. In principle, gross domestic product is equal to gross domestic income. You're just looking at the expenditures versus the income that people get from producing those things. So that's the basics of national accounting in a nutshell. And kind of like what was happening with imports and exports, national accounts tell us what is there, but it doesn't tell us why it's there. To know why GDP is at a given level or has shrunk or is growing, you need a production function. And most times when you think of a production function, it's the Cobb-Douglas production function, which tells us that total output is a function of how labor, essentially the hours that people work and the number of people in the workforce, combined with capital, which is the productive stuff we use to make goods or services, how those work together to produce output. You've also got this A term, total factor productivity, or an error term that's essentially how good is capital and labor working together? How efficient are they? Are there technological advances that make us be able to produce more stuff with the same amount of capital and labor? And this model of the economy is based on real statistical properties of the economy. What you see here, if you remember back to gross domestic income, this is netting out depreciation and production taxes from GDI. Essentially, you can think of depreciation as a measure of how the productive stuff we use wears out over time or accidentally breaks or becomes obsolete technologically. And so businesses have to invest just a certain level to stay where they are, to keep the same level of output. So you cover depreciation that way. Depreciation isn't really income that's accruing to anyone. It's income that's set aside to keep us up at that same level. And so when we look at the net shares of capital and labor over time, you see that they're fairly stable. These charts go all the way back to the 1930s. The shares between labor and capital are extremely stable, impressively so. And that lets us know that they're complementary. Essentially, when you increase one, you increase the other factor and you increase total output. And so that is the model that underpins the model that we have at Tax Foundation. Essentially, you start with labor and capital and you work your way up to production. And so now we can ask, how do taxes impact labor and capital and thus impact economic output? And when you think of a tax, you can think of it as creating a wedge between the sales price of something and the amount that somebody actually receives, what the person actually receives. It creates a wedge. It can be, you can think of an excise tax on cigarettes. So the sales price might be something. When you apply the tax, it increases the price to the consumer and it reduces the price the producer receives. There's a wedge between there. That's the amount of the tax. The same thing can be applied to labor. You have your wage and then you have your after-tax wage, and people are working for the after-tax wage. Similarly with capital, you might invest and get a return on something, say a 5% return, but after tax, that return might be reduced to 3%. So there's this tax wedge. And it's important to distinguish when we're thinking about taxes. You guys have probably had this in class too, between legal incidents and economic incidents. My favorite example of this is my daughter's in preschool. Her teacher might legally assign homework to her, but the actual burden of that homework falls on me, the parent. So even though it's assigned to her in name, the work of it is falling on me at home to make sure she gets it done. So that's the difference between legal and economic incidents. Who pays and who really pays. And then we're thinking about the total cost of the tax. That's the revenue raised by the government plus the economic damage or the deadweight loss that the tax imposes. And these ideas are important for policymakers to understand. That's where our work at Tax Foundation comes in. Because they might think they can place a tax somewhere and that that's something that they're placing a tax on is paying it. But the real economic burden of it might fall on someone else in the economy. And if they don't understand that, then they're probably not doing tax policy according to those principles that we went over at the beginning. It also helps policymakers design a better tax system so that we can minimize that deadweight loss and all have higher living standards. So the main way that taxes impact the economy are through changing incentives or changing prices through those tax wedges. How many of you have filed your own taxes or have paid taxes this year? Okay, cool. Was it a fun process? No, I didn't think so. Yeah. So how does a tax impact you individually to do one more unit of some activity? Say like sign up for one more hour of work, assuming that you have a little bit of leeway over your work schedules. Some people like me, on assign my work schedule, I don't get to choose, I'm not hourly. I don't get to say, oh, I'm only going to work, 35 hours instead of 40. But taxes can impact that incentive to either work one more hour or to even enter the labor force altogether. And it's not really anything to do with how high taxes are or how much revenue the government's collecting overall. It's that marginal impact on what's my return if I work one more hour. Do I get to keep a lot of that, a little bit of that? If the government keeps a little bit more of that 1 hour, maybe it's worth it to stay home and not do that additional hour of work. Same can be said of saving. If I save, so I earn my wages, I pay my income taxes on it. If I go out and spend it, I don't owe any more taxes to the federal government. I might pay state sales taxes on it, but I don't have any more income tax. If I put it in a savings account and I earn some interest on it, I'm going to pay another layer of tax on that. So the tax system's taxing the money on the way in and taxing the money on the way out. And it's putting a higher tax burden in percentage terms on that income that I save to consume in the future than it is on that income that I consume right away. And so you can see the tax system might distort someone's time preference of when they consume. Same with investment. And like we talked about that if I, want to expand my factory, if I want to upgrade the equipment that I'm using, how's the tax system recognizing that? Both how I get to depreciate it, that affects it, and the tax rate that I ultimately pay on that income. That can affect the return to capital. And it can mean that some investments that would otherwise be profitable are no longer profitable when you factor in that tax wedge. So this is from a blog post a colleague of mine put together on the folk theory of taxes in the economy versus this neoclassical theory, which is what I've been talking about, taking the price theory and applying it to the macroeconomic aggregates. So we can think through these 3 tax examples of how folk theory might say they would affect the economy versus how the Cobb-Douglas production function would say they affect the economy. So think about a retroactive tax cut. Most of you have already paid your taxes. What if the government comes along and says, oh, we're going to cut your taxes by 10%, but for last year? You cannot go back and work more. A business can't go back and invest more. You can't go back and save more money. Those decisions have already been made. So you can't really change the price of something that's already happened and expect it to change someone's behavior. But the folk theory or the politician might say, well, we're putting more money in people's pockets. We're putting more money in the pockets of job creators and of consumers that power the economy. But you go back to that Cobb-Douglas production function, you say, well, what grows output? It's capital and labor, and we're not changing forward-looking prices of capital and labor, so we're not really changing long-run output. The same is with temporary tax cuts, the idea of tax holidays, that sort of thing. You're not changing the long-run economy because you're not changing the long-run price of capital or the long-run return to labor. And this one is really important, this idea of revenue neutral tax reform. So again, most politicians will say, we need to cut taxes to put more money in people's pockets. And if we don't cut taxes, we're not going to be able to grow the economy. But you can raise a given dollar of revenue in a lot of different ways. You could put the tax on labor, you could put the tax on capital, you could put the tax on consumption. And it's where that tax is placed and how it affects incentives that affects growth. So you can raise the same amount of revenue, but it depends how you do it on the economic impact. So not all taxes are created equal. That's the big takeaway here. Taxes themselves can have differing impacts and different factors of production have different responses. So this hierarchy here kind of shows you 3 different tax types There's taxes on what you earn, taxes on what you buy, and taxes on what you own. And across those, you can have a spectrum of what's the most harmful and what's the least harmful. And ideally, the government will place most of its taxes on the least harmful types of taxes, but that's not always what we see in practice. One of the big driving factors here of how harmful or least harmful a tax is how responsive the factor is to tax. So think of someone says, I'm going to, increase taxes on your labor, but the next state over doesn't have as high taxes and the next country over has really low taxes. How likely are you as an individual to pick up and move countries in response to high taxes? Like not very, right? It's really hard to pick up and move as just an individual person. But if I'm a multinational business and I'm deciding, oh, am I going to put my next factory in France or in Germany or in the United States? That's pretty easy for me to shift capital. And if I'm just an investor, I can invest in, an international, developing fund, or I can put my money in the S&P 500. That's pretty easy for me to save my money somewhere else. So capital is a lot more responsive to tax than labor is. Same with consumption. Consumption is less responsive because there's just a basic amount of stuff you have to buy. So that's less responsive as well. And Ramsey efficiency is this idea of we should tax what the base that moves the least. And so we want to put taxes on not as much as high as capital, but more taxes on labor. That's more efficient. That's why you see here the payroll tax is most efficient when it comes to taxes on what you earn. So any questions so far? Okay, cool. Then I'm going to run through a couple of examples and applications of this, and then hopefully there are some questions raised because it would be fun to get into some Q&A, and I've got like a bunch of random slides with a bunch of different charts that we can look at if anybody does have questions. So we at Tax Foundation are very much in favor of the idea of full cost recovery. That means allowing a business to fully and immediately deduct what it spends on capital investment. And this chart here will show you why we think that is an important pro-growth policy. Accountants will typically disagree with us on this. And I don't know if you all have run into any jokes about economists versus accountants, but this is a good basis for one. But anyway, the corporate tax base is the measure of income that corporations are paying tax on. And you would think as a tax on corporate profits, it would be revenue minus expenses or the costs of earning that revenue. And that's true for basically any expense a corporation has, whether it's paying its workers, and for the most part, I'll get to a caveat on that, paying workers, paying utility bills, buying cost of goods sold, that sort of thing, except when it comes to capital investments. So if a business purchases something that's going to last longer than a year, it doesn't get to deduct that. Even though the cash that it spent on that all went out this year, on its tax return, it can only deduct a share of that. And that's problematic because of inflation and the time value of money. So if I ask one of you, can I borrow $100? And I'll pay you back in 5 years, but I'm only going to give you $100. Would you think that's a good deal? No, because if you had that $100, you could go invest it and do something productive with it. And 5 years from now, you'd have more than $100. But that's essentially what depreciation requires businesses to do, because in nominal terms, they get to deduct what they spent on that investment. But by waiting, depreciation or inflation and the time value of money erode the real value of that depreciation deduction. So this chart here illustrates what it looks like if a business invested in 39-year property. That's commercial real estate. So build a new factory or a new warehouse, some type of commercial structure. They have to deduct that over 39 years. So assuming a 3.5% real discount rate, some firms have higher discount rates, some firms have lower discount rates. This is just kind of a ballpark middle of the road discount rate. 2% inflation. We've seen higher inflation than that recently and still are. And the 21% corporate tax rate, in real terms, they only get to deduct $42. So that means their taxable profits are overstated by $58. They pay taxes on that artificial income, and this increases the cost of capital. This discourages capital accumulation. When capital, think back to the Cobb Douglas, when there's less capital, the marginal productivity of labor, of workers, how productive they are, because they don't have the tools or the technology that make them more productive. Okay, you can go sit in the chair. They don't have that. That means wages are lower and there are fewer job opportunities as well. So using our model at Tax Foundation, we estimate that allowing full expensing for short-lived assets, that's stuff with a 20-year or less useful life, mainly machinery, equipment, and software. Providing a full deduction for that, we estimate would increase long-run output by 0.4%, do all these good things for the capital stock, for wages, for full-time equivalent jobs, because it would encourage that new productive domestic investment. You can also think about the tax rate. What most people think of when they think of what's important about taxes is the rate. It's actually the rate matters because of what you are taxing, the tax base. So like I just showed you with the depreciation deductions, that's much more impactful in terms of investment incentives than the rate is, because if you get the base right, then the rate is not as important, because you wouldn't be taxing the normal return to capital if you allowed that full deduction. But the corporate tax rate does affect incentives to shift profits. So prior to 2017, if you go back and look at news stories of what like some of the big economic problems were, it was corporate inversions, corporations changing their headquarters to be headquartered overseas. There were some regulatory changes along 2016 and 2017, but the big shift that happened, as you can see on this chart, is that most nations in the world had been slowly lowering their corporate tax rates to about the mid-20s, while the US kept its corporate tax rate at 35%. And then there were also the average of state corporate tax rates on top of that, such that we had the highest corporate tax rate in the OECD and one of the highest in the world. There were a few countries that had higher rates than us, not any major developed countries. So the 2017 tax reform brought us down to about the worldwide average. And that significantly reduces the incentive at the margin to shift your profits and book them somewhere else, because there's less of a difference between our rate now and the really low rate countries. There were also lots of other changes in international tax reform that worked at ideas like ending other incentives to shift profits, particularly highly mobile like IP assets. They're really easy to move around on paper. So we provide a lower rate for those that are brought back to the US as another incentive to do that. But the big thing that changed was that statutory rate. Another big issue in tax policy since the Trump administration has been tariffs. So basically since the end of World War II, we saw a very, long decrease of tariffs, reduction in average rates as countries opened up to trade with each other, increased market access, reduced barriers to trade, including tariffs. And that changed under the Trump administration and the 2018-2019 trade war. So there's a few ways that we can think of tariffs impacting economic output here in the domestic economy. But I think the first big myth to get over when it comes to tariffs is like who actually pays them. Because if you, again, listen to politicians, you might hear one thing. But if you look at the economics of what's actually going on, you'll see something different. And so when the US imposes a tariff, the legal burden to pay that tariff is on the person in the US importing the good. It's not another country that pays that. It's the US business or the US consumer that's choosing to buy something from abroad, bringing it into the country. And when it crosses in through Customs and Border Patrol, it's their responsibility to write a check to the US government for that. So that's legal incidence. Economic burden could theoretically be on another country. If they lowered their import prices that we face, they would bear some of that burden. But that's not what we saw in 2018 and 2019. We saw across like all the academic studies, even a US study from the International Trade Commission, tariffs were passed through to US import prices. So US businesses paid them. After those higher import prices come through the border, then US businesses could choose a couple of things to do with that. It could just reduce their profit margin. They could pass that on to retail consumers, and then we would face higher prices. The other channel that it could happen through is if in the face of those higher import prices, US businesses stop purchasing those goods from abroad, that means we're sending fewer dollars abroad. So the global supply of dollars falls, the value of dollars increases, and that makes it harder for exporters to sell their goods on the global market because the dollar is now more valuable, making it harder for foreigners to, making it more expensive for foreigners to convert their currency to dollars and then purchase the stuff that we are selling. Usually you'll see some combination of all of those channels happen, and that's what happened with the trade war. The USDA estimated about 30 billion in direct export losses from US agricultural producers. That's why we saw those payments to agricultural producers. Manufacturers faced higher input costs because a lot of what we buy from China is intermediate inputs or capital goods, stuff that we use to produce other stuff. So it hurt manufacturing employment. We also saw some higher prices for retail consumers, like washing machines and dryers were more expensive. So all of those channels happened. Our model, we estimate that if those tariffs are permanently in place, it takes about a quarter off of long-run GDP when you factor in retaliatory tariffs. And that wraps up what I've got. Yeah. Yeah.
I know my accounting professor would scream internally if he tried to make that argument. Because fundamentally, I don't see how that comes over the fundamental issue with that it encourages massive short-term junk asset accumulation as a tax.
You only get the deduction if you're actually purchasing a good. In the 1980s, there were some issues with this, particularly with this idea called look-through buildings. So like I showed on that slide, deductions for real estate have some of the longest cost recovery periods, 39 years now. They significantly shortened that in the 1980s, and there were abuses like that, particularly with passive investors. So these people not actually actively involved in the business, doing this kind of like tax loss harvesting thing. Since the 1980s, though, there are a lot stricter regulations on that. Assets have to be in active business use. They can't just be, you can't just purchase something for your own good or whatever like that. Like you might have seen like recent news stories about questions about jets and people buying jets and getting tax write-offs for that. It has to be legitimate business use to get the depreciation deduction on your tax return. And I guess the other question is, it's not really do you get to deduct it or not? It's how quickly do we recognize it? So from the government's perspective, a $100, the government has a pretty low discount rate. $100 deducted over 5 years versus year one, to the government, there's not that big of a difference because its discount rate is so low. To a business with a higher discount rate, there is an issue there. And I have a little girl who needs to go to the bathroom real quick, so.
Okay, we'll
We will
try to
take a
formulate
bathroom
some questions.
Yeah, okay. Thank you all.
Chance for anyone to get more refreshments. Jacob, and we can sign in if we didn't. So. Try not to throw your food away in this room. I'm gonna try and find a appropriate trash can elsewhere. I might actually go try to grab that while we're waiting. I couldn't find one close enough.
Which I think I know the answer.
I don't think so, too. I mean, it's a good question.
Okay, do we want to jump back in? One more thing on the R&D in particular, a lot of what is spent on R&D is actually wages and salaries for scientists doing the work. So it's not even like a capital investment as we would normally think of one. But a lot of it is just wages and salaries that are immediately being paid out when it comes to R&D.
Incentivizes, I mean, pharmaceuticals companies already have this problem with ship. Public sector. Salaries themselves, it's just encourage that. There's already questions about cracking down. Only make that problem worse.
I might go in the opposite direction because it would be lowering the cost of making R&D investment. Yeah. Yeah, I mean, what we're talking about isn't, so it's a question of timing of the deduction. So a corporation is going to, in nominal terms, deduct that over time, one way or the other. The question is, how do we structure it in the tax so that we don't create a burden on the normal return to investment? So when you provide that full and immediate deduction upfront, that exempts the normal return to investment. But if you have something that's earning a super normal return, like say you have monopoly profits or rents, or you've done something really innovative and your return is above what you need just to break even, then the tax still would apply to that super normal return.
I have a question kind of, you sure? Okay, shifting gears a little, this past summer, I worked for a management consultant that was in the critical infrastructure industry. And so particularly, we were looking at electric vehicles and advising utilities on how to build that infrastructure. And that's when I learned a lot about the IIJA and the IRA, and basically the thousands of dollars an individual can get in tax credits. Just wondering what y'all like publications on that.
We have a lot of publications on that. Nope, I didn't throw that slide in. Yeah, so if we go back to those principles, neutral, stable, transparent.
Yeah.
Most of those IRA policies don't fall under that.
Yeah.
There were some improvements that the IRA made with like the production tax credit and investment tax credit, where before those were really confined to just some really specific types of technology. It broadened them to make them more technology neutral, but they still are just applying to a subset of investment across the whole economy. So the idea there is to distort relative prices to encourage capital to flow into that, rather than to broadly improve the tax treatment of investment across the entire economy to lift all types of investment in a neutral way. So on the business side, that's one issue. On the individual side, if you look at the stated goals of those policies and then how they're designed, there's a lot of conflicting issues that arise. So on the one hand, the idea of subsidizing a consumer to buy an electric vehicle is to reduce the cost, to increase EV adoption, all for the goal of, creating a greener economy. This green transition, reduce carbon emissions, improve the climate. So that's the goal. But then there's all of these other things that are riding along with that tax credit. So domestic content requirements, sourcing requirements for critical minerals, prevailing wage requirements, all of these other things that increase the cost of both producing in the US and of buying an electric vehicle, which works in the opposite direction of trying to encourage consumers to adopt EVs by lowering the price. So there's this conflict there by mixing these different types of goals. We also have a lot of research, not from Tax Foundation, but kind of in the academic space, looking at what other countries have done to use the tax system to reduce carbon emissions. And of course, this is the economist answer, but the most efficient way to do it is to do a carbon tax, to put a price on carbon, and then allow the market to sort out what are the technologies and what are the investments that are needed to get to those, emissions goals, given this new price of carbon with the carbon tax. So that's a more efficient approach. It also raises revenue for the government rather than costing billions of dollars.
Could you go to the slide where it was the taxes? Almost of that, I was just, I don't really have a question, Lloyd, so it's just if you could really go into detail on why each one is listed as like more kind of focused.
Yeah. Yeah, so with taxes on what you earn, we've talked a lot about this one where capital is more responsive to taxation than labor. So a given dollar of revenue earned from taxing capital is going to cause more distortion per dollar of revenue than from taxing labor. This particular point on individual income taxes and payroll taxes, the United States is weird in that its individual income tax also applies to a lot of business income. So if you've heard of a pass-through business, that's like a partnership or an S corporation or an LLC. Those businesses aren't taxed at the entity level. Their profits are passed on to individual owners, and those individual owners pay taxes on those business profits on their individual tax returns. So our individual income tax falls some on capital through the pass-through sector. It's a little bit less responsive to taxation than the corporate sector. Think of the difference between a multinational company being able to decide where to place its next investment versus like the laundromat on the corner. They're gonna stay in Manhattan. They're not gonna move to a different country. So there's a little bit less responsiveness there, but essentially it's that responsiveness. Taxes on what you buy, gross receipts tax. Has anybody ever heard of that before? I hadn't until my internship at Tax Foundation, and a couple of states were considering adopting gross receipts taxes. They're also called turnover taxes. So the deal with a gross receipts tax is that it's a tax on business revenues without accounting for the costs that a business is incurring. So essentially what it sounds like is it's a really gross receipts tax. It's a tax on gross receipts. And that causes pyramiding. So think of a farmer producing wheat, sells their grain to the mill, produces flour, the mill sells the flour to the bread shop. The bread shop makes bread, sells it to Walmart, Walmart sells it to you. Every step along the chain, there's been tax on gross receipts that gets embedded into the final price of the bread. So the bread to the consumer costs a lot more because it has taxes without accounting for costs along the way built in. So that's why that's a very inefficient tax. Excise tax is like a tax on cigarettes or a tax on a really specific type of good. It's a consumption tax. So it's less distortionary in that sense because it's not falling on returns to capital. But excise taxes tend to be on very narrow bases. So they're distorting relative prices. They're really high in one category of good rather than something like a sales tax, which still has its issues. In most states, we don't have a perfect sales tax base. Some sales taxes fall on business inputs like a gross receipts tax. So they lead to that pyramiding, but not to as great of an extent. And sales taxes tend to be on a broader base of goods at a lower rate. But you still have an issue with sales taxes in that they typically don't apply to services. Most sales taxes date back to like the 1930s when most of what we bought was goods. There wasn't this huge service economy. So it's not like on purpose or by design that sales taxes don't apply to services. It's just kind of happenstance for the most part. And of course, what politician is going to vote to, put sales taxes on your haircut and every other service that you're getting. So it's kind of an issue that's still there, but it's less distortionary. Taxes on what you own. Wealth taxes are very popular for politicians to talk about because it sounds like you can raise a lot of revenue with a really low rate. You'll hear, I don't know if you've heard Elizabeth Warren on the campaign trail talk about, we're just asking for 2 cents, just 2 cents. But if you think about a tax on wealth rather than a tax on income, a wealth tax is going to create a higher percentage tax burden on a low return investment than it does a high return investment. Don't have a marker here. Oh, I might have a marker. Let's see if I can think of something on the fly. Okay, so let's say, try to make the numbers easy. We have a 5% return investment and we have a 10% return investment. This is gonna be really hard to do on the fly. I'm bad at mental math on the fly. Essentially, okay, so let's say we've invested $100.
One of them works. I
There we
usually
go.
guess.
$100 in each investment. So I made a $5 return and I made a $10 return. And let's say, you know, this is adding to my wealth each year. And I have a 2% wealth tax, 2% of $5 versus 2% of $10. This is a $2 tax. Somehow it works out. We've got a blog post on our website. I'm not gonna be able to do the mental math right now, but a wealth tax sounds like a low percentage, but when you convert it to what it is on the change in the value of the assets that that person has each year, it's much higher. And when you look at the burden it creates on a low return asset versus a high return asset, it's higher burden on the low return asset, which is kind of the opposite of what you want it to be doing. It's discouraging those less risky investments and encourages risky investments. If we've got an email list, I can send around an example that shows that. The other issue with wealth taxes is just like a measurement issue. How do you value someone's private artwork? A lot of what's tied up in wealth doesn't have a market price. You know, a privately held business, what's that worth? You don't know until you sell it. So valuing those assets each year is really difficult. There's creative administrative ways to try to work around that, but it would be overcharging some people and undercharging others compared to reality. Not very many countries have them. I think, you know, in the past, it was something like a dozen OECD countries have them, and that's been falling off each year, particularly because of these administrative issues. The cost of enforcing a tax like that is not worth the revenue it raises in. Estate taxes run into similar issues, but that evaluation only occurs once. That valuation only occurs once when someone dies, so you're not each year trying to value someone's assets. It particularly though creates issues with entrepreneurial incentives and business incentives and that sort of thing. I would say a corporate tax is more harmful than an estate tax if you're trying to like gauge that way. And then immovable property is of course the least, like the tax base that doesn't move. So it's the most efficient one to tax.
Yes, I had a question in line with that. You talked about the concept of tax being transferred onto another party. I remember like the primary tax.
Yeah.
And so with the whole topic on like taxing the rich, what are like the main taxes that are needed to do that to target those kind of people? And then how effective are those, and are those passed on in any way or not?
Yep. So I think I have. So when it comes to the idea of like taxing the rich, I think that conversation typically starts from a place of not understanding the tax system we have today. We already have a very progressive federal tax system. State tax systems are less so, but the job of the states is not necessarily to have progressive systems. It's kind of the job of the federal government, and they help allocate things across states. So when we look at the federal income tax, these are average tax rates paid on taxable income. This actually overstates the rate paid by the bottom half, because the US tax system has things called refundable tax credits where people get back more than they actually pay in income taxes. And because of weird federal budget rules, those are counted as outlays or spending rather than tax. So when the IRS goes to make these charts, it doesn't count the outlays. So about the bottom quintile has actual negative income tax rates. That's not being factored in this chart here. So we have a progressive tax system already. Overall, even though we have some sources of federal tax revenue that aren't as progressive, like the payroll tax, because that tops out at a certain income level and you don't pay payroll taxes above that. That's also meaning you don't get Social Security benefits for income earned above that. So over a person's lifetime, Social Security itself is progressive, but when you're just looking at the financing side of it, it's a regressive tax. You do see the negative on the bottom, 50% in the dark blue. CBO gets to count the outlays in their charts. I don't know why, but they do. So we're starting from a progressive tax system. Typically what you see when you hear politicians talk about taxing the rich more, is raising that top income tax rate more, so making this chart go up more. We also hear politicians talk about increasing those benefits for the bottom, so making that negative go down even further by like boosting the child tax credit, boosting the earned income tax credit, policies like that. The effect on those varies. Something like changing the child tax credit, it can have incentives on work. So if you look at the way the CTC is structured now, this light blue line, and this includes other provisions too, like the earned income tax credit. Really low income earners face negative tax rates. So when they earn an additional $1 of income, it's met with like 40 cents of government benefit. But if they earn too much income, their marginal rate bumps up to just the regular brackets. So there's some cliffs there. Lawmakers don't usually think about charts like this when they're changing tax credits. So there are some low income people who face tax rates higher than what high income people face because of all these phase outs. So depending how you change these benefits, you can impact incentives to work. Same at the top end, you reduce the return to another $1 of income, you reduce the return to another $1 saving, you reduce the return to another $1 of investment, you get a lower level of that. Responsiveness varies a bit. Higher income taxpayers tend to be a little bit less responsive to that. Like they're not going to drop out of the labor force, but they might not put that additional work effort in. We also hear proposals to raise the corporate income tax rate. It's not just Tax Foundation that says corporate income taxes are the most harmful. There's research from the OECD and the IMF that look at distortions caused by taxes, and those tend to also conclude that corporate income taxes are the most harmful way to raise revenue. They aren't just paid by the rich either. So the incidence of the corporate income tax, politicians will say it's corporations. It's actually a combination of the workers at the corporation, the shareholders, and some studies show how it affects prices and consumers as well. Our model, we assume that half of the corporate income tax in the long run falls on labor. Some studies show labor bearing up to 70% or 100%. If you look at the official estimators of like Congress, the Joint Committee on Taxation, they assume 25% falls on labor. When you think about shareholders too, that's not just the wealthy. Anyone with a 401k, public school teachers with a pension, those are invested in the US stock market. So if you reduce the return to capital, you're also reducing the returns that they have in their retirement benefits. Of course, capital income is very skewed to the top, but it doesn't mean that it doesn't affect everyday people as well. So I think if you're really interested in proposals to increase the tax burden on the rich with minimizing the economic burden, there are options for progressive consumption taxes. We've recently done like a whole bunch of long papers that walk through what that looks like, but you can have a consumption tax that is still progressively structured. We've simulated one that essentially mirrors the progressivity of the current tax system, but also increases economic output by quite a bit because it gets rid of that tax on the normal return to capital.
Isn't that also a huge problem with property taxes versus say like land value taxation, where property taxation creates the incentive not to develop property because you face a higher bill?
Maybe to some extent. I will admit I am not super involved in our property tax work because that's typically in the realm of state tax policy, and I do a lot on federal tax policy. But if you do ever want to talk property taxes, I've got people who can talk to you about that.
Inheritance taxes all along there.
Yeah, that's a good question. Probably in the realm of estate taxes, and I'd say it would like depend how you structure it as well.
Any more sales on the internship? What some of your experiences were there that obviously inspired you to
Yeah. Well, at Tax Foundation, you actually get to work on real research and you actually get to author blog posts and co-author studies and have your name on them. You're involved in real work. It's also a really exciting work environment. We prefer our interns to be based in Washington, DC. We pay $17 an hour and it's full-time work. So that is enough to get you a room and get to do some fun things while you're there. We put together a really cool curriculum, reading group. We meet every Friday to talk through that. So we treat you like a full staff member. We expect our interns to be self-driven, to come up with research ideas, to contribute to projects, and essentially whatever you find that you're interested in as you're working on tax policy, we try to get you work that's in line with that. So for example, when I was an intern in summer 2016, there were a lot of states wanting to do soda taxes to essentially like fund pre-K in Philadelphia to discourage the consumption of sugar sweetened beverages. A lot of what you see there is that people just go to the next town over and buy their soda. So the tax revenue doesn't pan out. You don't get to fund your programs and people are still drinking sugar sweetened beverages, or they substitute to things that aren't facing the tax that are also sugary or unhealthy. Particularly at the local level, it's like a very ineffective excise tax. So I got to write some blog posts on that as an intern, which was really fun. And then I also got to write a research paper on gross receipts taxes as an intern. So yeah.
Is, housing is not provided?
No, housing is not provided.
Well, I'm sure Eric will stick around and visit with anyone that has other questions, but let's thank our speaker. If you could, for all the food, use that big trash can I went and grabbed, so we're gonna take it back to where it was from. Grab soda, grab water, grab pizza on your way out, feel free to hang around. If you didn't sign in, please do so. I know a couple people came in a little late. Now we need to get everybody's information and we'll be back. Like on Tuesday, so I guess that's 5 weeks. Early April. 4 weeks, 5 weeks. I can't get it straight. 4 weeks. I don't know. Anyway, first Tuesday in April. Oh, yeah, good to see you. Yeah. I didn't see who that was at first. Yeah, glad you could make it. Just put your name down. And we'll get you on the listserv if you want to include your email. High school.